In today's video, we are going to go through the top 5 stocks for 2024. These are all high growth, high momentum, and high relevancy stocks. I will go through each of them and discuss why they're a top stock, whether they are a good deal right now, some play ideas on them, how to play them, and the projection for where they're likely to go. And if you appreciate all the work that goes into a video like this, the only thing that we ask in return is that you hit that ravishing like button, and of course, do not forget to subscribe. Okay, number 1, NVDA, the chip dictator, the chip-tator, if you will. She controls the hottest industry right now, and if you're sleeping on her, you're sleeping on the rest of the market. This is a stock that no matter what kind of fear, uncertainty, or doubt that has been thrown at it, it just keeps rocketing. This stock has enjoyed the very rare phenomenon of being able to routinely add billions and billions, tens of billions to its market cap week after week after week for years. And to resurrect a meme from Charlie of 2023, Nvidia has no peers, and everyone only focuses on her. She's the one that gets all of the eyes, and there's good reason for this. The reason is because she is the center point AI play. She's the purest way to get real AI exposure, but she's also a massive moneymaker in the here and now. Nvidia has become one of the biggest companies in the world because of her ability to create and sell the highest performing GPUs used in gaming, AI, data centers, autonomous vehicles, and a host of other high computer processor demanding fields. But the question is she a good deal right now? And the answer is absolutely yes. This morning, she hit a new record high at $603 a share, so yeah, by that stretch, she's actually more expensive than she's ever been, but you know when she also looked like this? Well, pretty much every single record high she's hit throughout her history. On May 25th, 2023, we made our NVDA is unstoppable video and made our case to buy her, and since then, she's gone up another 53%. NVDA's growth potential is exponential, so even though she was certainly in the nosebleeds back then, well, she had a lot more to rally and continues to do so. And that's because just looking at the stock price is not a fair way to analyze a company. You have to ask yourself what bang you're getting for your buck. You can't compare NVDA stock price to where it was a year ago, 2 years ago, 10 years ago. You have to compare what you were getting for that stock price if you want to analyze whether or not it's a good deal. In terms of PE ratio, you're actually paying far less for NVDA's earnings than you have for most of the last year. And this can be even more misleading because if, and I'd argue when, NVDA beats expectations at earnings next month, well, this number is going to be adjusted even lower as it has been the last 2 times. Now, if you remember, I've made this case before back in August of 2023. We made our NVDA 210X video, and we spoke about how despite record high after record high, she continues to skyrocket because the AI sector has unlimited potential and investors let their minds go to the moon on it. But that a lot of people don't understand that there's actually also not just hype here, but real math behind the buying. And this is the real math here. Again, you have to follow not just the stock price, but what you're getting for every dollar you're putting in a stock. And at that time, earnings had just come out and her PE ratio dumped dramatically. She dumped to a PE ratio of 112. And so in that sense, even though NVDA was more expensive than ever from a stock price perspective, well, you were still getting way more bang for your buck than you had done previously. And today, even though we're at a new record high, this is a similar situation. And in fact, today you're getting even more bang for your buck at a PE ratio of about 78. And quite frankly, this should drop again after the next earnings that come out on February 21st, just next month. So when people say, no, NVDA is more expensive than ever, show them the PE ratio, show them a lot of the trends that you're seeing under NVDA. Does that mean that NVDA is not due to dip or breathe when overall markets stop capitalizing really good companies? No, it doesn't mean that. But it does mean that you gotta look at what you're paying for, because if you're getting more than you pay for, it's hard to say it's more expensive than ever. Now, obviously, the good deal searcher, cheap dude, cheap Charlie in me is saying, yeah, in an ideal world, we need a big dip to really accumulate. And I do believe that if there's a massive dip on NVDA, that is the best time to accumulate. But at the same time, as somebody that's covered NVDA for many, many years, I'd be careful endlessly waiting on this stock. Many people for years have waited and waited on NVDA to have a massive dip, and they are still waiting. And they will continue to wait until NVDA is at a price that doesn't have any justification. And then they'll go buying in guns blaring. And that is when everybody that bought it at a good price is like, okay, now it's time to take my profits. Now it's time to take my profits. That said, the stock, in my view, is going to be a top player for decades. So with that in mind, what is the play here? Well, you have a long-term play where you could buy shares, and you also have a medium-term play where you can trade off the current momentum that is here before you get the next dip cycle. If you want to play the record high momentum that is brewing right now, well, I'd look at the April 19th expiring 650 strike calls. Remember, if you have a small account, well, trading options can allow you to leverage your money far, far further than just straight up buying shares. For example, if you have, say, $3,000 to play NVDA, well, $3,000 buys you about 5 shares of NVDA stock. If you put that same $3,000 into options, though, you can buy these 650 calls, giving you the power to control 100 shares instead of just 5. Controlling 100 shares versus just 5 shares is a big difference if the momentum on NVDA continues. And that's why if you have a small account, using some form of options might be very, very advantageous. Now, of course, if you are a complete beginner and you'd like to learn options from the ground up, we do have a program for you, Zip Trader Options. That first link down below, coupon code HELLO2024 will get you 50% off. We'd love to have you. But other than that, keep in mind that NVDA is going to be a killer heading into the next 5-10 years, and will in all likelihood be a massive killer in the coming months. Okay, number 2, crypto miner Mara. Now, you already knew this one is coming if you're a longtime follower of this channel, but Mara is the killer of crypto mining. We've covered Mara for years because she is the leader in crypto mining. As of late, she ran massively as Bitcoin euphoria grew, heading into the SEC approval of the Bitcoin ETFs, and she's been in a take-profit cycle since then, but she's starting to show some lovely signs of bottoming. And as we head into Bitcoin halving in April, I believe you will see Mara move far, far, far more aggressively to the upside than you did even just last month. And she moved pretty fast last month. Way overshot our expectations that we had predicted back in December. I believe that she is going to absolutely destroy these cycle highs that she had just hit at $31.97. She's in an accumulation zone right now and attempting to bottom, but once she wakes up, she'll be a much harder horse to catch. So I would focus on Mara right now before markets have really started recapitalizing her. Some will say, Charlie, I'm looking at Mara and I don't want to buy a falling knife. I don't like looking at falling knives. I just hate falling knives. And others, when Mara is back at an all-time high, they'll be saying, oh, you know what? I can't buy a stock at an all-time high, or I can't buy a stock unless it's hit 10% over an all-time high, or I can't buy a stock because it's only halfway to an all-time high. All of these things are just excuses. You have to look at a company and decide whether or not it's undervalued, whether or not that momentum is going to continue, whether or not the catalysts are going to drive it to the level that you want it to be at. You can't look at it as just, oh, what is the price currently at? Because you'll always find an excuse not to buy it based on that. In my view, Mara is particularly well positioned to benefit from the next wave of euphoria into Bitcoin, which has historically happened before halving, and halving happens this year in April. So we have a couple months for Mara to really play out. Right now, you're at a pretty deep discount. Number 3, Tesla. So Tesla has earnings coming on Wednesday this week, and it's been an underdog as the other Magnificent Seven have hit record highs or made at least massive jumps towards them. Tesla is down some 17% in the last month, and it's trading at around half of its all-time highs that originally hit at 414. So why, Mr. Charlie, the lack of enthusiasm? Well, we haven't really been in an economic condition that has prioritized cars and especially EVs. As interest rates went up, people weren't able to spend as much on cars, and as savings were depleted, well, EVs weren't the top choice for people. And to maintain sales momentum in 2023, Tesla aggressively cut vehicle prices and offered discounts throughout the year, and that has panicked investors quite a lot. Auto gross margins, which peaked at 30% in Q4 of 2021 amid industry chip shortages, have plunged well below 20%, and people don't like to see that. Tesla's margins are still some of the best by far, but they still are in a bad direction. On top of that, you have some recent bad headlines like Hertz deciding to sell its 20,000 electric Teslas, and overall global EV momentum has been slowing. But here's the thing, many people are undervaluing, once again, Tesla's 2024, 2025, and 2026 performance and new chapter. The problem is that once again, markets are focused on Tesla as just a car company and nothing else, which of course, anybody that follows Tesla for 2 seconds knows that that's not the case. That's not what Tesla is. It's way more than that. Now, Elon Musk, the Musk of Elon, sent a message on X to someone criticizing him for wanting more shares in Tesla via compensation package. I'll read it directly. Quote, I am uncomfortable growing Tesla to be a leader in AI and robotics without having 25% voting control. Enough to be influential, but not so much that I can't be overturned. Unless that is the case, I would prefer to build products outside of Tesla. You don't seem to understand that Tesla is not one startup, but a dozen. Simply look at the delta between what Tesla does and GM. Blah, blah, blah about stock ownership. Now, markets have spent time debating how this this makes Musk greedy or how he's going to build a Tesla competitor and that's going to destroy Tesla, blah, 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 blah. But this is just one of many games over many years that Musk has played. Tesla itself has always been and will be the AI company, robotics company that Musk has envisioned. Tesla as an entity is perfectly positioned and capitalized and has the manufacturing and team set up to most efficiently execute his AI and robotics goals. And the reason that Tesla is the pick today is because this is going to be the year that Tesla most clearly turns the chapter from just EV company to full-on software AI robotics company. And while that vision comes more and more to fruition, well, you're going to see this stock join the ranks of the other Magnificent Seven stocks that have been getting to newer and newer highs. With Tesla, that's likely to mean beating those 299 highs reached just last year. Cycle highs reached then were at 299, so to play that, you can buy June 21st, 300 strike calls in the mid $4 region right now. There's a million other types of option strategies and share purchases that you can make to play off that. I would argue that Tesla may have a little bit of a panic into earnings on Wednesday, may panic after earnings, but overall, bigger picture, you're going to see Tesla fill in and get to those new cycle highs, especially because overall markets right now are pumping to support big tech, Magnificent Seven stocks, and even others as more and more capitalization flows around the market. Number 4, Alibaba. Ticker symbol BABA. This will be, of course, a very controversial pick because it's Chinese and China's in a bad economic rut right now, amongst other things. However, BABA is trading at just a bit over lows it hit in 2015. This stock has been absolutely and utterly destroyed, but keep in mind that the company is doing great and China is the second biggest economy in the world. I think we all have a difference of opinion on how they should be running their country, but they have some 1.412 billion people. Their middle class has been growing rapidly and getting richer and richer. China's GDP per capita has been skyrocketing decade after decade. BABA is one of the most well-known e-commerce companies within that massive country. And when you talk about what you're getting per dollar, well, I mean, you're talking about a PE ratio of 14.8 right now. This is the cheapest mainstream e-commerce company in the world by leaps and bounds. Even when comparing it to previous Alibaba valuations, it averages at a PE ratio of 47.9, and just in 2022, it was at a PE ratio of 94.1. Right now, Chinese stocks are in a very, very aggressive fear cycle, and they have been for years now, but it's hard to imagine that BABA doesn't age to be one of the best recovery plays of our time. So, plays on this, well, I would say straight up shares or farther out options. It's clear BABA is a good deal, but it's unclear how long markets will take to recapitalize on her, so a medium to long-term position is required. Aside from shares, you could buy LEAP options dating out to 2025 or 2026 for pretty cheap. You can pick up January 2026 150 strike calls for around $3 today. Pretty good leveraging power. Okay, finally, honorable mention number 5, Meta. Meta right now is in what I would call an unquestioning euphoria cycle based half on real numbers and half on pure hype. Originally, markets hated Meta because they thought Zuck was going too ridiculous on pivoting towards a pie-in-the-sky metaverse concept, and they were worried about ad rates falling off a cliff as some 90% of money managers expected 2023 to enter us into a deep, unrelenting recession. But as a surprise to money managers and yours truly, well, the much more mixed economy resulted in a much more mixed result for Meta and better than expectation beats. In the latest quarter, which ended on September 30th, 2023, Meta reported that ad impressions on its family of apps segment, which includes Instagram, WhatsApp, Messenger, and Facebook, grew 31% year over year, but the average price per ad declined only 6%. So net in effect, they're doing well. Usage and impressions are growing at a pretty rapid increase, justifying a lot of their bounce back. And while advertising revenue after going into a massive recession in 2023 and for half of 2022 still hasn't really recovered, it's a lot more stable and at a much more healthy pace as predicted when Meta had originally been sold off. Now that being said, is Meta a good deal? No. I feel uncomfortable with Meta at these prices for anything other than a very short-term momentum play, and even then, it worries me. The simple truth is the cash burn with this metaverse segment is huge, and growth in impressions and usage in WhatsApp and Instagram and the other platforms, that might not be sustainable. I mean, we need a couple more quarters to see how sustainable it is, and of course, if advertising is still going to be blunted, that's not a great combination. It's very, very easy for Meta just to sell off after the next earnings report or another earnings report down the road. If, or rather when Meta dumps back down to 300, 250, that's when I'd start taking it seriously for a dip buy, especially under that 300 level. Yes, you can make a somewhat strong argument, not a very exciting argument, but you could make a somewhat strong argument for playing a little bit more momentum on Meta as she breaks out past those all-time highs. I think a higher strike call heading into Q2 would be okay, but remember, the minute this confirms a downtrend, the minute that you have a bad earnings, that is when all of a sudden I'm making picks for puts on it. So Meta, honorable mention, something that people are going to want to know. I'm not super bullish on Meta. I think that Meta is very, very, very much going to have a freak out in the coming quarters. Over many years, hey, sure, it'll do fine, but you got a lot of FUD hanging over it with that big, expensive metaverse concept that they're trying to push. So something to think about. Anyways, that caps off our top 5 stocks for 2024. Let us know down below what your favorite stocks are and why. Anyways, we appreciate each and every single one of you. Thank you for tuning in. We'll see you in the next video. And of course, a reminder, if you do want to get 50% off our Zip Trader options program, I'll put the link to that down below. Coupon code HELLO2024 expires at the end of the month, and we'll get you that discount. See you, folks.